First of all, thank you very much, and I'm really having a great time. This is a fantastic forum. I'm sure my colleagues on the panel would agree that we often are asked to speak about Islamic finance, but very rarely in such a rich and interactive and enjoyable setting as this. So really, the privilege for us to be here. I'd also want to particularly express my appreciation for the question that was raised before about the, if you will, the personal or the spiritual aspects of all this Islamic finance, because at the end of the day, really, there's a moral and ethical principle base behind all of this. And it reminds me of something that Professor Vogel and I were discussing a few months ago. Professor Vogel was preparing for a talk in Kuwait on the ethics of insolvency in Islam, al-Iflas. And so we were talking about this, and then I said to him, Frank, you should talk about Hadith al-Muflis. And he said, remind me, Hadith al-Muflis, what is this? So this is a hadith. Muflis is a bankrupt person. So the Prophet, peace be upon him, went to his companions one day and he said, Man al-Muflis, who is a bankrupt person? And they said, Allah and His Messenger know better, but Fina al-Muflis, alladhi la dinar lahu wa la dirham. That God and His Messenger know best, but amongst us, a bankrupt person is somebody who doesn't have any gold coins, doesn't have any silver coins. And the Prophet said, no, in my community, the bankrupt person is the one who will come on the Day of Judgment, but he would have prayed, and he would have fasted, and he went on and listed a number of good deeds. And he said, but he would have lied to someone, or he would have cheated someone, he would have stolen from someone. And the Prophet went on, I'm paraphrasing the hadith. And so these people will take from his good deeds until he is left with none. And then he will take from the bad deeds of these people who he wronged until he goes to the hellfire. So this iflas, there's an ethical component to all this. I mean, we talk about finance and we talk about all this, but really what Islam is trying to get us to do is not, it's not only a financial question, but there's the interplay between the ethics and the financial transactions are so fundamental. Anyway, my role here will be to talk about from a Gulf context, and I'm very conscious of the time, and I feel I want to leave as much window as possible for the interactive part. So I'll just say a few points and leave it at that. When we talk about Islamic wealth, you've heard a figure that was cited today, $1 trillion in assets, and I think it's a reasonable one. Standard & Poor's has something around that in their estimate. But when we talk about Islamic wealth, I think we underestimate the market size for a couple of important things. So the middle of the bullseye is what we're talking about when we say about $1 billion. But don't forget that there are also the Islamic windows of conventional institutions. So I used to work at HSBC Amana, where we managed a significant amount of assets that were Sharia compliant. They didn't show up in the market sizing because it was HSBC. And more importantly than that, and especially from a Gulf context, are what we call the Sharia neutral assets that are held in conventional entities. So that means the person who's keeping his money in Mashriq Bank or in Bank Al-Ahli, National Commercial Bank in Saudi, or any of these banks, and keeping it in the current account, not collecting interest, and they are an Islamic investor. Or I'll give my own example. I live in New York. I'm a Citibank customer. I keep my money in Citi in a current account, and I don't collect any interest on that. Now, nowhere will I show up on the market sizing of Islamic finance, but I'm an Islamic customer. So in any case, I think that there's a big market there, and we've seen it kind of growing in recent years. There's the interplay between the GCC and Islamic finance is important to keep in mind. So just as a basic point, of course, Islamic finance is not limited to the Gulf, nor did it originate in the Gulf in its modern form. Some of the earliest thinking actually is traced more to Egypt and also to Malaysia and elsewhere where this was done. So Ahmad al-Nagar from Egypt, for example, with Midghamar and elsewhere. So it's not that it's confined to the Gulf. However, when you look at the evolution of Islamic finance, it's very much moved with the Gulf. So the first big wave of Islamic financial institutions was founded in the 1970s on the wake of the liquidity and the wealth that was created in the first oil booms. And although the thinking had existed before, the institutions were not present. Then the second big boom came in these 2000s, again with another oil boom, another seed, a wave of wealth that came through. So really the Islamic finance industry grows when the Gulf grows, but by no means are the two the same. And of course also we should keep in mind that the Gulf overwhelmingly, certainly from an institutional perspective, is not Sharia compliant in its financial activities. So it would be a fallacy to think, for example, of the Abu Dhabi Investment Authority as somehow representative of Islamic investment, because it's not an Islamic or Sharia compliant institution. So in any case, as I say on the slide, about 2/3 of what we call the addressable market of Islamic finance is in the GCC. Addressable does not include Iran. If you put Iran in here, And the reason why it's not addressable for many global institutions, the sanctions and other considerations prevent them from doing business in Iran. That would change the number slightly, but still, the key message is that the Gulf is really a core market, or the core market, for Islamic finance in terms of volume. Although you see Malaysia has 17%, which is a single country, is second only to Saudi Arabia. I won't talk about this in detail, but when you look at the landscape of institutions in the Islamic finance space, you've got local banks, and by number, these are the biggest, the greatest number. So banks like Bahrain Islamic Bank, Bank Islam Malaysia, Qatar Islamic, and the list goes on. You've also got regional banks. So this is a new phenomenon of banks that started in one country and spread elsewhere. So Dubai Islamic Bank is one, obviously started in Dubai. It now has offices in Malaysia. It's spread into Pakistan. So it's developing more of a regional presence. Mustafa Rajahi Bank from Saudi, a similar story into Malaysia. Kuwait Finance House, again, Malaysia. So you see this expansion going on. And the creation of regional institutions. And this is a bit of a tangent, but just to underscore the point, a lot of the evolution has to do with issues that are not related to Islamic finance in particular, but rather broader regulation. So you would expect that a Saudi Islamic bank the first market it would expand to would be Kuwait or Qatar or the UAE, and that's a sort of typical business expansion strategy. Doesn't happen due to regulation and other broader market factors in the GCC. So we're operating in a certain environment that we didn't create as Islamic financial institutions. There are the multinational windows. I mentioned HSBC Amana. Citigroup, of course, has Citi Islamic. Standard Chartered has its own business, Al-Buraq, I believe they call it. And there are a myriad number of Islamic windows in these multinational institutions. And then there are specialist firms like Sheikh Yusuf was referring to, Shariah Capital being one of them, R Capita, Unicorn. And these are specialist firms in the sense that they only provide one specific part of financial services. They're not full-service banks, but they're very important by way of innovation. Now, I wanted to speak very briefly about the authenticity challenge that was raised. Professor Vogel said it, Mr. Mughal also touched on it, Sheikh Yusuf, so I think it's a common theme. Now, as a practitioner, and I'm speaking as a practitioner in the industry, when we talk about the authenticity challenge, there are these four elements of it. Customers expect something that's very similar to conventional finance, at least the vast majority of customers that we deal with. So they want something with a risk-return profile. If we take a home financing as a very good example, this is a true story. One colleague of mine went to the Sharia board of Bank Negara Malaysia, the Malaysian National Sharia, the central bank, the Sharia committee, and he introduced them. He was talking about a musharaka, or a partnership, equity-based home financing product. So he showed them the product. One feature of the product was that in the event of a loss, the bank shared in a loss, and in the event of a gain, the bank ceded its gain to the customer. And the scholar said, this is a wonderful product, but why don't you claim this gain? If you are a musharik, if you are an equity participant, then this is your right. And he said, Sheikh, you show me the customer who's willing to give me upside on his home, and then I'll introduce that product. That's the reality of the market in which we operate. So that's the truth that we face. Regulatory constraints. Banks, being a bank is a serious endeavor, and with, of course, the regulation reform, and Professor Werde was going to talk about the crisis and how that's impacted things. Obviously there were big regulatory constraints. Banking regulation was designed for money lending, which means taking money and then lending it forward, not for equity participation and for the more risk-bearing activities that we undertake. So it's a big challenge. If you want to be a bank and you want to have central bank guarantees to take deposits, then you have to act in certain ways which are very, very conservative and which lend themselves towards murabaha and debt-based financing modes. And that's if you choose to be a bank. If you choose not to be a bank, then the world is much more broad. Competitive pressures are real. I can tell you again firsthand at HSBC, there were products